Welcome to the deep dive. Today, we're jumping into something a lot of business owners grapple with.
Mm-hmm.
It's that push and pull, investing in commercial real estate, thinking long term versus needing that cash, like right now, for the business.
Absolutely. It's that big question. Is buying this building the right move for the future, or is it going to drain the funds I need for, well, running the show day to day?
Exactly. That's the core of it.
Yeah.
Seeing that potential equity grow versus the immediate reality checks.
It's a powerful vision, owning property, but yeah, it has to square with keeping the lights on and fueling growth now.
So our goal with this deep dive is to hopefully bring a bit more clarity to that whole balancing act.
Sounds good.
We've sifted through quite a bit, articles on CRE strategies,
Yeah.
how to really pin down what your business needs property-wise, general investment tips for smaller businesses, and those big comprehensive CRE guides.
And the common thread really is that tension, isn't it? Wanting that solid, long-term real estate asset
Right.
versus the absolute undeniable need for healthy cash flow to just operate and ideally expand the business you have today.
Okay, so let's try and unpack this balancing act. I mean, fundamentally, it's managing competing priorities,
Yeah,
different timelines.
it really is. You're building for, 10, 20 years down the line, but you also have payroll next week.
Yeah.
I like the analogy of maybe walking a tightrope while carrying groceries. You need focus, careful steps, maybe some adjustments along the way.
Ah, that's a good one. It captures that need for, well, balance.
Precisely. It's not just A or B. It's finding a way for both the long-term vision and the immediate needs to work together.
So it really comes down to planning, being flexible, and truly understanding where your business stands now and where you want it to go.
Uh-huh.
Our sources really hammered this home.
They did. And that first step, that deep assessment of your business needs, that's absolute foundational. You can't skip that.
It's more than just a quick look at the square footage, right?
Oh, definitely. It's about really analyzing your current operations, your workflow, and having a realistic projection, not just a hope for future growth.
Because you need to think, okay, if we buy this place, how does that actually change things day to day? Does it help? Does it create new problems?
Exactly. And then looking further out, does this move set us up for where we want to be in 5 years, or could it actually box us in?
The materials we looked at really emphasize doing that homework before you even think about making an offer.
Yeah, looking at the core stuff. Location, is it really practical for staff, for clients? The space itself, buying too much is costly. Too little hinders growth.
And that transition piece you mentioned, how disruptive will moving actually be? That's often underestimated.
Massively. Downtime costs money and momentum. So ease of transition is a big, big factor.
Okay, so let's say you've done that assessment, you have a clearer picture. What are some smart strategies for actually doing the balancing? Diversification came up a lot.
Yes. And interestingly, not just in the broad sense of stocks versus bonds versus real estate, but diversifying within your real estate approach. So maybe you own the building you operate out of because that offers stability.
Okay.
But maybe you also keep significant cash reserves or perhaps invest in something like a REIT for exposure without the direct ownership burden.
So it's not just building versus cash. It could be, say, owning your main facility, but maybe having other capital in more liquid investments, maybe even different types of properties if that fits.
Exactly. Maybe your core is an office, but you diversify with a small warehouse investment or shares in a retail-focused fund, spreading the risk.
And you mentioned REITs again. Maybe just quickly explain those for anyone unfamiliar.
Sure. So REITs, real estate investment trusts, are basically companies that own, operate, or finance income-producing real estate.
Yeah.
Think office towers, malls, apartment complexes.
Okay.
Buying shares in a REIT lets you invest in a large portfolio of these properties. It's generally much more liquid, easier to sell shares than a whole building, and requires less capital upfront.
Gotcha. So it offers that real estate exposure, but with more flexibility, potentially less hassle.
That's the idea. It's a way to participate without becoming a direct landlord, essentially.
Which leads nicely into another strategy we saw, lease flexibility, especially if buying isn't right or isn't right yet.
Crucial point. If your business is, say, growing really fast or maybe facing some market uncertainty, getting locked into a 10-year rigid lease can be a real problem down the road.
Yeah, I can see that.
So the sources suggest negotiating for shorter terms if possible, or building in options clauses that allow you to expand to adjacent space, or maybe even contract if your needs
I
change.
saw mentions of things like spec suites, ready-made spaces.
Exactly. Those are often pre-built, move-in ready offices that minimize your upfront fit-out costs and often come with shorter, more flexible lease terms. Great for speed and lower initial commitment.
And those expansion or contraction clauses, they seem like a really smart hedge against the future, don't they?
They really are. It's about building adaptability into your real estate commitments, aligning them better with the potential ups and downs of the business cycle. Avoids being stuck paying for empty desks or bursting at the seams.
Now, underpinning all these strategies, diversification, flexible leases is something more fundamental.
Wrong.
Knowing your numbers and your goals.
Oh, absolutely
Mm.
critical. You can't balance anything effectively if you don't know what you're aiming for.
Right.
Setting clear, measurable business goals for next year, for the next 5 years, gives you the context. It tells you why you're making a certain real estate choice.
Is this property decision helping us hit that revenue target? Or is it supporting our plan to enter a new market? It has to align.
Precisely. Are you optimizing for, say, steady, predictable cash flow right now? Or is the main goal long-term capital appreciation, even if it means tighter cash flow today? Your objectives dictate the strategy.
And it's not a one-and-done decision, is it? The sources really stress checking in regularly.
Definitely not. Things change. Your business evolves, the market shifts. So, periodically reviewing both your business performance and how your real estate assets are performing is vital.
Asking those tough questions, like, is this property still profitable? Is the return meeting expectations?
Mm-hmm. Or are we paying for space we just don't use anymore? Could we sublease part of it to generate some income?
That regular review seems key to staying agile and making sure your property continues to serve the business, not hinder it.
It is like preventative maintenance for your strategy. Catch issues early, make adjustments.
Let's talk about some creative solutions that came up. Subleasing you just mentioned, and shared workspaces too.
Yeah, these can be really practical ways to optimize. If you own or lease more space than you currently need, subletting a section can bring in cash flow, help offset your own costs. It's found money, essentially.
Makes sense.
Yeah.
And shared spaces, co-working spots, they seem like a good fit for certain types of businesses or maybe younger companies.
They can be fantastic. Lower overheads, you're not locked into long leases usually, and you get a professional environment without the capital expense of fitting out your own office.
Plus, potential networking benefits, maybe.
Potentially, yes. Being around other businesses can sometimes spark collaborations or new ideas. It's about finding the most efficient model for your specific space needs at that point in time.
We touched on REITs earlier as part of diversification, but they also fit here as a kind of creative alternative to direct ownership, right?
Yes, absolutely. For businesses that want a piece of the CRE action, the potential returns, without the headaches of being a direct owner and manager.
Yeah, the maintenance calls, tenant issues.
Exactly. REITs or other real estate funds offer that exposure. And crucially, as we said, there's often better liquidity. Selling shares is usually quicker and easier than selling a physical building if you suddenly need cash.
Okay, now, regardless of how a business approaches CRE buying, leasing REITs, there was one point that came through loud and clear from everywhere.
Let me guess. Cash reserves.
You got it. The absolute necessity of having enough liquid cash on hand.
Non-negotiable. It's the safety net. Business always has unexpected bumps. A big client pays late, equipment breaks down, a pandemic hits.
Right.
Having that cash buffer means you can handle those things without having to panic sell assets or jeopardize your core operations, especially important if you have tied up capital in a long-term real estate play.
The idea of a dedicated rainy day fund was strongly recommended.
Yes, earmarking funds specifically for contingencies and keeping them somewhere safe but accessible, like high-yield savings or money market accounts, not locked away completely.
So you're not forced into bad decisions when something unexpected crops up.
Exactly. It buys you time and options.
And finally, this whole landscape isn't static, is it? The market itself is always moving.
Constantly. Real estate values fluctuate, local economies boom or bust, interest rates change, new developments spring up. You have to stay aware.
Keeping an eye on local trends, vacancy rates, what comparable properties are selling or leasing for.
All of that. Being informed allows you to anticipate shifts and, crucially, be ready to adapt your strategy if needed.
So what worked 5 years ago might need tweaking today based on current market conditions.
Absolutely. Maybe refinancing makes sense now. Maybe it's time to sell a property that's peaked. Or perhaps consolidating space is smarter in a downturn. Adaptability is key to long-term success in CRE.
Okay, so wrapping this up, it really boils down to, well, a few core ideas.
Hmm.
That upfront, honest assessment, really planning based on your business needs now and future. Staying flexible in your approach, whether that's leases or investment types.
Diversification, not having all your capital tied up in one illiquid asset.
Right. And always linking your real estate moves back to your clear business goals. Are they aligned?
Thinking creatively to subleasing, shared spaces, REITs as alternatives.
And that critical safety net,
Oh.
cash reserves. Always have the rainy day fund.
And finally, keeping your ear to the ground, staying informed about the market, and being ready to adapt your plans.
It's definitely an ongoing process, not a single decision.
That's maybe the biggest takeaway. It requires continuous attention and adjustment.
So, for everyone listening, maybe just take one small step this week. Could be just reviewing your current lease terms or taking stock of your actual cash position or even just brainstorming those business goals for the next couple of years.
Good advice. Small steps add up.
And remember, figuring out this balance between property investment and business needs, it's a common challenge. You're definitely not the only one navigating this.
Definitely not. And perhaps a final thought to chew on. As our world gets more digital, with digital assets becoming so central to many businesses, how might that interplay between the virtual and the physical evolve? How will the need for and the value of physical space change, and how will that affect this balancing act we've been discussing? Something to keep an eye on for the future.